Hello, everyone, and thank you for joining me to learn about options. And so today I'm going to talk about options, but not just options, but options on gold and silver and gold mining companies, and particularly some of the things that we can do. Obviously, as a gold and silver investor over the last couple of years, it's sort of like being stuck in purgatory, isn't it? Just waiting and waiting for things to happen. How many of you asked the question, is there something I could have done? In the last couple of years, is there something I could have done to generate income off of my gold and silver and gold holdings? Is there something I could have done to protect the downside risk in my investments? Is there something when the market turns around and starts to arise in the gold and silver, is there a way I can leverage the potential gains on the other side? I want to explore all of this with you in this journey of this 20 minutes about options and how we can utilize them as a strategic tool. But to do that, I want to talk about the cyclicality of gold and silver. And so I want to particularly touch on this because it's so important to understand in context of putting options on what a cycle looks like in gold and silver miners. And so what I want to start off with is looking particularly at the cycles in the GDX, the gold miners ETF. And we're going to have two criteria for measuring the cycle. We're going to have the criteria that the trend must be of at least 2 months or greater in duration. And the move has to have been greater than 20% to the upside or at least a 20% decline. Okay, so that's the criteria we're using for a cycle. So I ask all of you, how long do you think the average gold miner cycle was? Do you think 5 years? How many of you think 3 years? How many of you think 1 year? How many of you want to find out? Let's take a look, all right? And so what I've done here on a histogram is actually showed the bull and bear market cycles based on the criteria we set out. And so we're looking at 12 years of GDX back to its origins in 2006. And we're identifying those cycles as in those 12 years, there were actually 15 cycles. In those 15 cycles, the average length has been about 9 months, both higher and lower. Isn't that interesting? But look at the magnitude of the rises and falls. The magnitude of the rises have been in the kind of 89, 90% during those rallies that occurred in the GDX. That's average, right? And the average decline, which many of us have experienced, is about a 43% decline. Our current cycle is we're in the midst of a decline that's been about 12 months in duration and has been just over 30% in decline. So it's been longer, but not as deep as past ones have been. Right? So I want to use this, I want to always remember these numbers because we're going to use this when we get back to some examples. So I want to talk about options as a strategic tool. And so in order to do that, I want to introduce you to the first type of an option, which is a call option. And a call option is the ability for us as a contract between two counterparties. The buyer of the call is securing the right to be able to buy an underlying security at a fixed price over a fixed period of time. And the counterparty, the seller of the option, has an obligation to have to sell it to them if they wanted it. The beautiful part about these options is they're American style for the majority of options, which is that they can be exercised any time. So the call buyer pays a premium and at any point can actually call in the stock and actually purchase it. Now, we're going to focus in this situation particularly on the long-dated options. We're going to go 1 and 2 years out. Why? Because we just talked about how long an average cycle has been. About 9 months, give or take. So if we go and we're looking at these longer dated options that have 1 and 2 years of duration, we have a pretty good probability of actually capturing one of these cycles. And so what I want to do with these long-term options, we're going to take a look at a scenario of how these investors did, because a lot of people mistakenly stereotype options as particularly risky. And while they can, if used incorrectly, create enormous amounts of risk, that's not necessarily how I want to introduce them to all of you. And so let's do a comparison. We're going to take 3 investors that are investing into the GDX. And so in this scenario, we have investor A, who's a stock-only investor, which I'm sure many of you fit into that category in the audience. And so you would just buy the physical shares and own them. Investor B is a conservative options investor. They're not seeking using the options as a way of attaining leverage, but rather as a strategic tool in order to get participation in the GDX and manage risk along the way. And the third, or investor C, is one investor that wants leverage. They're seeking to juice up their trade. They want to get a little bit more out of the upside or the downside of a move, and so they're turning to the option as a way of attaining that leverage. So let's compare how these investors have done. So in this example, just to keep it straightforward, everyone at this moment is bullish the GDX. And all these investors each have $20,000 to allocate to this trade. Just for simplicity, we're going to do that. And the GDX, well, all of you obviously are gold investors, so what did the GDX close at on Friday? $19, right? So we're taking the Friday's price. All of these slides have actually been updated with the prices that you would have gotten on Friday. And so it was trading at $19, and we're going to look at a long-dated option to January 2020, not 2019 to 2020. We're going to go 440 days out, and we're looking at a call option that gives us the right to buy those GDX shares at $19 a share. And we essentially, by buying that call, have the right to buy in the stock at any time between now and January 2020. Now, that option costs $3.50. So let's look at the different scenarios. What does Investor A do? Investor A just has $20,000, wants to buy some GDX shares. They're going to buy 1,000 shares. They're going to buy 1,000 shares, $19 a share. They've allocated $19,000 to the investment. This is something that we all do on a regular basis, where that investor is left with $1,000 cash. And the Investor B buys 10 call options. What I didn't show earlier was that each call option represents 100 shares. So if you want to control the same 1,000 shares as Investor A, how many calls do we have to buy? 10. Right? Now notice here that this investor is not using that option to attain leverage, that they're just simply using it as a strategic tool to control the same 1,000 shares that Investor A is. Right? So now that costs $3,500 in premium. So the investor allocates $3,500 to the call options. The exposure is $19,000. They have the right to buy in $19,000 of GDX at any point in the next year and a half. Now they're left with $16,500 in cash. They started with $20,000 and only allocated $3,500 to this trade. This is important because when we get to the later example, we're going to reference back to this cash balance. So Investor B, now let's look at Investor C. Investor C wants more leverage. So instead of wanting to control 1,000 shares of the GDX, they want to purchase 1,500 or control 1,500 shares of the GDX. Using the same call option as Investor B, they simply are buying 5 more of them. So they've allocated $5,225, and they're controlling or have the ability to buy in $27,000 of GDX stock. And the cash balance, though, remaining, because they've only allocated $5,000 to the trade, they have close to $15,000 sitting in cash. Everyone following along so far? So, rather than me making up scenarios, let's just go back to what we discovered when we talked about the cycles. We've discovered that the average cycle is about 9 months in length, and the average gain is about 90%, and the average decline is about 43%. And so let's use that as our base case to go through scenarios of what happens to all of these investors. So Investor A, in this scenario, let's say the GDX is going to go up 90%. We caught the cycle right, where the GDX begins a rise, and it proceeds to rally to $36 a share. So in this scenario, you can see it's a very linear relationship, dollar for dollar, everything that everyone knows. Every dollar the GDX goes up, we make $1,000. That's a very straightforward linear return. So how did Investor B fare in comparison to Investor A? So notice here, Investor B starts a little slow out of the gate. They're suffering a little bit of time premium decay on their option and are not really profitable on the first dollar advance. But one of the beautiful parts about options is the delta relationship that increases the rate of which the option is participating on the upside while you own it. Notice that once the stock is going from $30 to $36, dollar for dollar, the call buyer is actually almost making the same return as the stock investor, up in that scenario almost $6,000. The beautiful part about options is that the more right you are, the more the option behaves like the underlying equity. Now, how did investor C do? Similarly to investor B, investor C, who leveraged up, is essentially right off the gate a little bit slow on the start because they're suffering time decay or premium burn on their option. But at the same time, you can see as the returns are accelerating on the upside, so is the returns that investor C is making. What I want you to take away from this slide, can we agree that when gold rallied, whether you were investor A, B, or C, you made very good money? You were able to participate on the upside of the gain, and whether you use the shares or the stock, the shares or the options, you were able to gain some way of benefiting from the rise of this position. So let's go to scenario number 2. And scenario number 2 is the stock did nothing. For 9 months, the stock does absolutely nothing, and the GDX 9 months later is exactly at $19 where it's trading today. So how did the investors fare? And this is the disadvantage of options, is that we suffer time decay. We pay a premium for an option, and we have a carry cost. And so what happens is that as the investment, as we own this option, there's a certain amount of time decay that is occurring that an investor that owns the share is not occurring. And this is the trade-off that we have in options, is the fact it costs money or premium to actually own them. So how did, though, the investors fare during the scenario number 3, which is that the GDX proceeds to decline 40% over the next 9 months? Now, investor A experiences the same linear relationship on the way up, on the way down. They're experiencing a dollar for dollar loss as that is occurring. And so every dollar GDX goes down, you lose a dollar. But how did investor B fare? Investor B started out of the gate losing a little bit more because they're suffering time premium burn at the same time as it is going down. But notice this beautiful asymmetry, that as you're becoming more and more wrong on your investment, you're losing at a slower and slower pace. So what happens is the loss that you're actually incurring is actually materializing because the delta is actually shrinking on the option. Similarly, investor C, who made more money than investor A, what do we assume when we talk leverage? Is that someone who uses leverage should make a lot more money on the way up and should lose a lot more on the way down. But yet, investor C actually gets the same benefit as investor B in a sense that the rate of the option decaying is actually losing at a smaller and smaller pace. And so even though all of our investors made very good money for being right, those that utilize the option as a strategic tool, when wrong and the gold miners went down, were losing less on the way down. And that's the asymmetry in being able to learn to use options as a strategic tool to be a gold investor. So investor A, down $8,000. Everyone understands the scenario. But investor B and C, I want to point out is that while they've lost money on their options trades, they still have what? A very large amount of cash on the sideline. And this is the second beautiful part about options trading, because investor A, who owns the share, what is your only choice? Dollar cost averaging. So what are you going to do? You're going to take this beautiful new $20,000 that you had on the sideline, bring it in and buy more stock. And now you're tying up more and more of your capital to trying to bring your average price down to your entry point. But notice that investor B and C have all of this cash still on the sideline. The original $20,000 that they had wasn't in the underlying investment. So while they lost money on the way down, they have all this cash on the sideline to take advantage of the GDX now trading at 11. So what's really an amazing thing that they can do is now they can turn around and buy more call options at the $11 strike when they originally bought it at 19. And so in this scenario, investor B and C, now we're going to go 9 months forward. So today is July 31st of 2019. 9 months have passed. We were wrong. We lost money. The GDX went down in that cycle. Now GDX is trading $11. So using an option pricing model based on the implieds and so on, we can determine that that option would be roughly trading at about $1.90. That's obviously using a simulator, but we can guesstimate what the value of that option would be. So what we can now do is look at a new 2021 call option. So the original calls we bought were 2020s. We were wrong. It went down. We lost money. But we now can reposition at the new lower price down at the $11 strike with new 2021 options and basically put ourselves in a position now to profit from it. So look at this. Investor B has $16,500 in cash. Remember, we determined that earlier. And so investor B can now, to control just the same amount of cash that they have, can buy 15 call options at 11 when they were losing on the way down with 10. So now on the way back, they're participating with 1,500 shares on the way back up, even though they were losing on the way down with only 10. In the similar scenario, investor C can turn around and utilize 20 call options and attain a little bit more leverage, and still both of them have $13,000 in cash and $11,000 in cash respectively, sitting on the sideline after being wrong and repositioning on the options. Options not only have the asymmetry in terms of the fact of the way that the price behaves, but also with you not deploying all your money at once, you have all the strategic ability to reposition at tactical moments in the marketplace. So I want to share with you in the final few minutes some great trade ideas, and hopefully all of you can enjoy them. I have only a few more minutes, so if anyone wants a further explanation on these, you could come and see me at the booth over there, Big Picture Trading. I'm happy to explain any of these in greater detail. So the first one, I want to talk about Goldcorp. Recently weak on its earnings. The stock was on Friday at $8.85. We could turn around and sell an April $7 strike option for 20 cents, a 6-month duration, which is a return of about 2.85%. That annualizes a 5.7% income. That's the same kind of as a dividend from AT&T. We can turn around, generate a cash flow. If we're exercised, we're buying in Goldcorp at $7 a share, average cost $6.80 with the premium we've collected. It's a great way to dollar cost average on your gold shares and turn a way of generating some income while you're waiting. And trade number 2 is a hedge wrap that we can do on gold bullion. You must have heard a number of speakers talk about the idea that if the dollar was to rally, that gold can remain weak even for another even year. Now, if that scenario happens and gold is heading back to 1,100 or 1,000, but you have gold bullion in your vault, or you have gold exposure, or even the GLD, and you're looking for a way to manage the risk, you can, in this case, go to the futures market. As an example, out to January of 2019. What we're doing is selling premium on our gold at the $1,300 call option, which was trading at $7 an ounce. We receive a $700 credit for a gold futures contract call. We can turn around and buy a $1,200 put, hedging all downside risk below $1,200 on gold, and that would cost us out of our pocket $630. You walk away with pretty much a zero-cost hedge, where you're actually make a small credit, and you basically collared in your gold price between $1,200 to $1,300, removing the downside risk to the upside. Of course, you have to be tactical about not cutting off the upside, so you might want to roll up if the gold starts to rally, but it's a way of protecting yourself and not costing you any money to do so. And the third one, which is one that a strategy that we used to actually catch the top of the S&P 500, it was a calendared straddle actually we did, but in this case, silver had a little bit of a breakout, and we wanted to discover whether the silver breakout was going to have legs or whether this is a false start. So what we did was we turned around and bought a March 29th $12 deep in the money call option at for $2.08. And we turned around and we bought a 30-day hedge out to November 30th at the $13.50 strike. By doing so, it's giving us a month to find out whether the silver breakout's for real. If it doesn't, we've limited our risk down to $50 for every 1 one call put combination we do, and we could walk away or adjust the hedge. But if it works, we are in a longer dated position that's long silver right off of the bottoms. So those are just ideas of the types of things you can do when you incorporate options into your gold and silver investing. Nonetheless, I want to just take a moment to point out what we do and how we do it. Big picture trading. We take market insights, macro insights through our macro podcasts and through all of the study we do. We do use market timing through all of our analysis that we do, and we use options trading to build the asymmetry. And that is what we are, big picture trading. We do a top-down analysis of everything. Those of you that are new to options and you think this is intimidating or you don't know where to start, we have a special today at the Silver and Gold Summit, a special package for $99, which is a 3-hour live options webinar that's with me covering how options work, what you do, how you do it. That includes a 30-day membership to my service where you get all of my trade alerts, all of my ideas, and all of my analysis. And we make it a no-brainer at $99. And to make it even a better deal, if you're not happy, we have no problems with giving your